Today's stock slide and the drop in oil prices raising concerns that the global economic recovery is faltering. We'll ask my next guest where investors can go to seek shelter. Steve Blitz is senior economist at ITG Investment Research. And Steve previously has been at Salomon Brothers, where he created derivatives market strategies. He was global fixed income group, was with that group at Lazard. So you've certainly had a lot of time on the street, Steve. Thanks for coming in to talk to us.
Great, thank you.
There seem to be a lot of growing concerns about what's going on with the economy. What is your data telling you? What specifically are you looking at?
Well, we look at a number of different things, and our data told us very early on, back in early March, that the economy was stalling out, and that's exactly what did occur. So that wasn't a surprise. The real issue is going forward, what's going to happen. And if this was just sort of a normal type of recovery, the type of events that we had, such as the earthquake in Japan and the impact on the supply, would really not be that big of a deal in terms of you get a little bit of a down move now and then it reverses back later in the summer. But we're not in normal times.
So I guess resilience is sort of the key word here, that we're not seeing a very resilient economy right now.
Well, it's not resilient, and it's not resilient because the work of this recession isn't done yet, and that is the deleveraging of the U.S. economy. And the monetary and fiscal policy has done its best to, in effect, shield the private sector from that impact, but in waiting for the economy to come back. But it hasn't, and the political patience with these policies has run out. And so beginning in July, we won't have QE2, and then we'll have some sort of a fiscal drag of some sort or another created between now and August.
Well, will there be QE3? That's a sort of a growing drumbeat out there.
I don't think so. I don't think so because basically there isn't the political support for it. And the Fed's running already a very tight line between its political independence and dependence, especially with the House. And I don't think that if sort of an ad hoc, we're going to do this unless there's really catastrophic economic news that puts all the political chips back on Bernanke's side. Without that, I just don't see it happening.
Yeah, I'm curious what kind of data that you've been looking at sort of to predict what's going to happen. I mean, there are the obvious headline numbers that we've been seeing recently, jobs being the most foremost among them. One thing that we were talking about earlier today on Bloomberg was the carloads information, the rail carloads. In other words, that data has shown sort of a decrease in carloads. Is that something you look at? What are the other sort of under the radar, if you will, indicators?
I look a lot at railroad data that comes out weekly. It's interesting. The last time that data was really predictive, or indicative, I should say, of the overall economy, people didn't carry phones around. So it tells you it's been a long time. One of the things that we look at, aside from that, is hotel rates, the ratio of weekday to weekend rates, and just the general trajectory. And what we saw earlier in the year was really a rapid increase in acceleration in room rates for weekday stays. And beginning in March, we just saw that flatten out. And
that seemed to indicate business demand, in other words, that hotels felt like they could raise the rates for business travelers during the week.
Right. A hotel is an apartment building that releases every night. So it really has a very high beta to the overall economy. And it's very, very reflective of what's going on. And weekday rates, as you just said, you're 100% correct, is very, very much indicative of business travel. And what we saw was that the upward move just flattened out, and beginning with rates that would be, say, for June. And we're seeing an increase in September rates right now, but that's seasonal. And they're still not really accelerating, say, past last year rates to give us a sense that there's sort of a renewed bid. What there is actually a strong bid for weekday rates this summer in New York City, but I would say that New York City hotels, but I would say it's probably a lot of shoppers coming for bargains.
Yes, and maybe a lot of European shoppers, although the dollar strengthened a little bit. And we're discussing concerns over what appears to be a slowing economic recovery. My guest is Steve Blitz. He's senior economist at ITG Investment Research, who has been reading the tea leaves, or hotel rates, as the case may be. And I'm curious, when you look at sort of the root causes, why hasn't the economic recovery taken hold in a more substantial fashion?
Well, I think it's a very simple answer. There's just still too much debt against assets that have depreciated. And in terms of assets that depreciated, yes, housing is a big part of that, but also equity prices. I mean, if you take a look at sort of the major financial stocks in terms of their market value on December 31 of 2006, we're still about $900 billion underneath that. That's a lot of money. Now, granted, the stock market's gone up and money's been made elsewhere, but it's still a tremendous amount of money against that was $1.9 trillion that people borrowed against in one way, shape, or form. So you're in a balance sheet, as you've heard many times from many guests. We're in a balance sheet recession. It's a balance sheet recovery. These things take time. You know, our expectations are shortened by communications being so rapid, but economies kind of lumber along on their own pace. And lowering interest rates, as we've seen, if there's no reason to borrow, being able to borrow cheaply doesn't change anything. And being able to borrow, for example, at low rates for mortgage rates doesn't matter if a first-time home buyer has to come up with 20% and a very high credit score.
And needs a job for that matter.
And needs a job for that matter,
So at this point, it's a demand problem, not a liquidity problem.
Yes, it is. And that's why the fiscal side, a lot of people say, well, that's, you know, but I think to a large extent, the fiscal policy that we had was misspent in terms of being able to produce the types of products, or invest, I should say, in types of projects that would have the multiplier to keep things going. I mean, they did what they could, but as I said before, the political will to go forward, arguing one way or the other, I mean, the political will is just not there.
You know, on the flip side, one of the areas where we had seen demand, at least perhaps until recently, had been the corporate world. I mean, you know, we've gone through earnings season after earnings season where things have seemed to bounce back. When QE goes away, does that fall off a cliff because, you know, rates were so low, there was ample liquidity, and, you know, you could argue demand on the corporate side of the equation. So what happens?
Well, the first thing I think to understand is that when QE2 goes away, it's not as if it's a light switch that goes off or goes on. And these things, it has a way of QE2 will have the end of QE2, just as the start of QE2, it's a cumulative effect. And I would argue that the full cumulative effect of QE2 on the real goods sector, which is really the part of the economy that's done so well, hasn't yet been fully felt. The real goods sector that you're talking about, it is the healthy part of the U.S. economy, but it needs demand, and it looks for that demand in export growth. And export growth has been tremendous, and that has fueled a lot of the corporate profits that you're talking about. And the idea that's helped that through QE2 is that it's weakened the dollar back to pre-recession levels, and especially against our Asian trading partners. So from that perspective, the real goods sector has done very well. QE2 pulls that away a little bit, but the real impact of it probably you don't feel until later in the year or early next year.
Okay, so let's break it all down here. What do you do with your money? Because if you're looking at this sort of grim scenario for the economy.
Well, I wouldn't call it grim. I mean, it's not grim in the sense that we're going to get another recession, and I would not expect to see job losses in the coming months. I mean, you may get 1 month, but I don't see it as moving in that direction as a trend. In terms of where you put your money, I think that right now, I think cash, even though it hurts, is probably the best place for a short amount of time. As the liquidity goes away, I think the risk markets reprice to the economy we have, not the economy they expect. And once that occurs, then I think you're more than safe putting your money back into the equity market.
So you really do kind of batten down the hatches and wait. I mean, cash is, you're pretty conservative.
Well, yeah, I mean, you know, it depends what, you know, it depends what kind of, who you are. You know, any investment decision really depends upon what your true liability is, you know, and if you're in your 20s and you don't care because it'll go down and come back up again. If you're in your 60s, it's a different perspective.
Do you think that there are any sort of segments of the U.S. economy that are going to lead us out here that'll be, since you look at these indicators, what are you expecting to start to recover earlier? Well,
I would think the same sectors that have done well will continue to do well. I think high tech and the real goods sector in general. I think looking for the real estate sector to do well, I think that's more of a flyer. Eventually it will turn around, but if you're talking about somebody who wants to be a little conservative with their money, today's probably not the right time. The same with the finance sector. simply because nobody really knows right now, because of Dodd-Frank, what business banks are in and what their earnings are going to be. So I think the real good sector is the place to be, and I think just a little bit of repricing here, and it's a great place to go.
All right, Steve, we have to leave it there. Steve Blitz talking to us from ITG Investment Research.